Hello and welcome to Aprons Bank. My name is Jonas, I'm head of asset management. Now I try to briefly go through our house view. That's, to cut it short, very unchanged since last week. We're still bullish. Peak Åkersnäs is past us, pivot is past us, and peak CPI is past as well. That was an executive summary of what I'm going to talk about for about the next couple of minutes. But first of all, when we look into 2023, the sort of the 6 charts, we will expand and look a bit more in coming webcast that we will do on the 7th of December at 10 o'clock in the morning. So please have a look at that. I will send out the invites on my social pages as soon as I have time, which I hopefully sometime today. One of the things we would expect to happen in 2023 is that uncertainty will come off the table. I.e., we will glide down to the historical patterns in terms of macro uncertainty and also financial uncertainty. We also believe that in terms of paradigms, we will start off the year in a macro paradigm, which is the running paradigm right now, i.e. US daily high frequency macro models are about running about 50-60% of the entire equity market, both in direction and magnitude, which is quite interesting. The trough in leading indicators on a global scale is also something we will work with in 2023, i.e. what does it mean that the world rebounds when we know that Europe is, for example, cyclically challenged, although not equity challenged anymore. I will come back to this. We also know that for a fact that national accounting profit data in US has troughed. It will be interesting to see what would that mean for S&P 500, for example. And the blockification, the relationship between the different equity markets has broken down in 2022. Will it come back or not? And also, obviously, the Fed. We're going to move into cut environment, which will be quite interesting if that was to happen in 2023. Now, if we look at the coming data for the week, I have bolded a few of the what I think are more key than anything else, and I will look through that data a bit now. First of all, non-farm payrolls, we have 125,000 positive contribution to the economy from non-farm payrolls. That's higher than our indicator, but that indicator has been, we're still working on the statistical challenge of the pandemic, so that's why we're careful on that one. We put a bit more weight on job postings, for example. As out of consensus concern I have is the Saffir-Simpson scale in terms of hurricanes and the severity of those and bad weather effects on non-farm payrolls. We have had quite severe effects from hurricanes, not so much of an impact on actual non-farm payrolls. That could be we could be past it already, but it could be something to keep an eye on in the data, i.e. the underlying on the beneath the non-farm payrolls. I mean, how many were not able to come to work due to weather. That data stream will be quite interesting, at least for ourselves. Then obviously unemployment rate should start to tick up, which is obviously, given the levels we're at, not surprising and quite welcome by the fixed income market and the dovish camp and an equity market. We can skip this, but obviously if you look at the underlying demographics of where the labor market's improving or not improving anymore, we're talking about the Fed should start to consider changing direction on the Fed. I will come back to that. And then we have ISM. ISM, I think, it's always a bit tricky with ISM, because please do remember that the headline ISM number is not the mean of the underlying variables. It's a separate question in the questionnaire. And also, as soon as the equity market rebounds as sharply as it has in Q4, you always have a split in how the market is looking at survey data and hard data. If you look at hardish data, you have this on the left-hand side. If you look at proper hard data, you have this on the right-hand side. And you can see that, well, maybe going down to 50, then we're going to model on and rebound. But we always know that this survey data, as in 2019, I think the pandemic was a bit off here, off in the sense of reading too much into the future of it. But we always know that survey data is always extrapolating positive news, like we did in 17, 18, and extrapolating negative news, whilst hard data is moving with the market and the economy. So we will view a weaker ISM as great in terms of pushing down the 10-year, which is a position we have. It's going to help equity markets. but we're not going to be too concerned about what it actually means. And the reason for that is that if you look at survey data, yes, ISM should come in lower, and you have a great fit here historically, but this is combining soft on soft. We know that the equity market is more prone to follow hard data. So what does it actually mean? And you can also make this this reasoning a lot more complex by the fact that you could argue that the equity market has already priced a sub 40 level on the ISM. I'll show you a graph later on. And we also know, just to make everything a bit more tricky, that the equity market is leading ISM with 3 months. So what would a softer ISM actually mean in that sense? We are quite certain that a lot of people are looking at and distinguishing between hard and soft data. So we don't think it means too much if ISM was to come in lower than 50. We have 50 in the market. We stick more to hard data for our positioning. And also, please do not forget that the equity market is already troughed and indicating a positive OI above 50 level again. So ISM is great for media and pundits, sell side, etc. I doubt it will move too much on the buy side of things, in my opinion. The economic sentiment in Europe, yes, will come in lower, but no one really cares because Europe is not about the real economy side anymore. We're so certain from an economic point of view that we're going to end up in a recession in Q1, Q2. You can actually start to label or play around with the opposite idea. We have a consumer conference in Sweden, record lowish numbers, appalling numbers. And I'll come back to that. It means in terms of consumption, but obviously the whole situation in Sweden has been front-run by the situation in real estate. And if you remember, back in January, we went out with a very negative outlook for Swedish housing. And it's not rocket science. I mean, just look at building permits. Right now, we have the lowest reading on building permits that we've had since the mid-1990s. And obviously, house pricing is falling over a lot, meaning to a lot of personal stress among Swedish consumers that are already consuming in a yearly growth rate as if we were in a deep recession, i.e. comparable to the great financial crisis or the 90s crisis. And this was the state of things before the first hike from the Riksbank. So I know the Riksbank now rhetorically like to think that they want to slow demand, that's why they're hiking rates. But they hiked rates when retail sales was already at the recessionary level. And I think that's really something that we should keep in mind when we're looking forward in terms of how far can they actually go before they're going to have to change and start cutting again, like the US. Obviously, the debt service ratio in Sweden is very high and just going to keep on going higher, notably a lot lower than the US. The historical reason is obvious here that US cleaned up their mess from the financial crisis. In Sweden, we did not. And what I mean with clean up their mess is obviously they didn't clean it up. They just rolled it in the society, to the banks, to the national state, etc., etc. In Sweden, we were not able to do that. The same party trick in that sense. So the things are a bit different here. In this cycle, all the things that were negative and not having that choice or that policy strength is come back to haunt us in Europe and Sweden more so than the US. And also please do remember that whilst things are very dire for a Swedish consumer, they are not for the Swedish manufacturer that is greatly enjoying the rebounding global economy and the currency rate. So you have levels now that are considered to be peak growth almost. I mean it's extraordinary strength. The split between the manufacturing and retail sector, you have that in the blue. And when the manufacturing sector leads the retail sector, that's actually quite positive for the equity market. Because we all know that, yes, we do know that Sweden might end up in recession or not in Q1, Q2, but does it matter for the equity market right now? No, it does not. The equity market trades on global macro right now, if you look at OMX, for example. I would be a bit more concerned about small domestic Swedish businesses and their equity price rather than the ones that have a manufacturing side. And in our stock picking, we have tilted the portfolio to take this into account, of course. Now, another country that we bought into is Italy. And that can sound really weird given the fact that we're about to enter a recession in Europe. I'm not too certain that will actually happen, but even if that was to happen, that's already been priced. Right now we are hunting the second derivative, and what's interesting is that Italian equity market is not too difficult to front run with macro, traditional macro. You can almost see it, 6 months ahead of times where things are developing, especially if you're looking at yearly growth. But even if you look at just a second derivative, you can start to play around. So we've been preparing to buy for quite some time, and when we saw the rebound in the equity market and we got the confirmed signals, we bought it last week. Why Italy? Well, do remember we already are invested in European banks in France and Spain, but Italy obviously has the highest GDP recovery from the pandemic. They have the highest disposable income. The Italian bad debt issue is becoming a little bit more of a thing of the past than not. So a lot of things are talking about the Italian economy, but to be brutally honest here, we could as well have bought DAX, but the things were pushing us into Italy well, basically the reason was that we saw more positive and skew in terms of for Italian equity market than the German. Another thing that's great for Europe, and you remember that we've been talking about systematic stress in Sweden, for example. If you look at the improvement in systematic stress for Europe, it's been quite dramatic. We all know what happened in April, June, July in 2020. Will the same thing happen again? I'm not so sure, but the fact that peak systemic stress, we can read it, global hawkishness, happened back in October is quite significant, and also creates a lot of better condition for the equity market. So even though we know that we might end up in a recession, we would argue that it has already been priced. The equity market has to be 6 to 9 months ahead of actual macro, i.e. GDP data. It's very easy to say in retrospective. It's a lot harder to take the positions right now that we have decided to walk the hard way here and pick up European equities. So our house view is pretty much unchanged. Peak hawkishness, past, peak yields, past us, peak inflation, past us, pivot, done. All these forecasts or house views are unchanged. And we'll see for how long we will be able to do that. We will actually be on a little bit of a break next week from this video, so we'll be back in 2 weeks, so we'll see what happened up to then. But so far nothing's really changed to alter this slide where we have our strategies that we implemented, how we forecast the equity market, what we think on the macro. Obviously the week ahead is rolling a bit, but in terms of things, our strategies is unchanged. The tactical asset allocation has been key this year. I've been talking about this every week now for several months, over half a year I think, and it's still that way. And it's going to be that way until the fixed income market can show to break away correlation-wise from the equity market. But being able to work tactically with FX, with vol hedging, and even being short sometimes has been key this year, I think. In terms of performance, we're on a green traffic light, i.e. 80% of our mandates are doing their work, i.e. beating the benchmarks or maintaining their medium-term returns. And we're looking at those portfolios with $50 million and above. These are a few examples here, or these are the examples here. And you can see that, yes, we're down on the year and we're fighting the index in terms of allocation portfolios, but obviously on the longer term, we are outperforming quite neatly. And also on global equities and rates, we have a relatively better year, still a tough year, of course. On the global equities, we are working, as you can imagine, quite a lot with the dollar. Why hasn't the dollar proportion shifted down? Well, because our dollar strategies are performing so well. So even if we take away dollar strategies, the ones remaining are showing a tremendous growth strengths, i.e. biotech or water purification in the US, etc., etc. But we are definitely increasing Swedish krona and euro exposure. And so we are performing 8% per year gross fees, and with currency exposure open in that sense. The strategies are the same, so quick run through. We are still believe that we're going to be in a soft landing after this week, after we get the JOLTS data and non-farm payrolls data. What I think is a bit interesting now is we enter 2023, is that we're entering the year of a pre-election cycle, which is during a normal, these things are never normal, but during the 4-year presidential election cycle, the third year is from an economic point of view and an equity point of view, always the best, because we have the midterms behind us. We know what's going to happen, and we can start to prepare for the election cycle. Obviously, that's a good year, historically. We think 2023 will be a good equity year. And we quite like to see an inverted head political risk coming off a bit. And that 2023 is not just due to the election cycle, but the fact that CPI will collapse in front of our eyes. These are the indicators indicating that CPI peaked, and it has already peaked. Some of these things peaked back in March, but the rest of it and the actual CPI number has now peaked as well. And I will only show the updates here. The updates, first of all, is the daily CPI basket from the Fed, which is just going lower and lower, which is a positive thing. The other thing is quite interesting is that the price mechanism between home prices in the US and owners' equivalent rent is starting to work on the downside as well. And this data will actually be updated this week. Quite interesting how fast these things unravel on the downside. And nothing unravels as fast as supply bottlenecks. If you look at the supply delivery time as a proxy for supply bottlenecks, you can actually see you now have the lowest print ever recorded, i.e. maybe Grundlach was correct in arguing for deflation. This will be a severe disinflation next year. And this is just not the Kansas Fed. You have the Creighton University, you have New York Fed doing the same work, i.e. sharply lower inflation from the CPI supply bottlenecks pressure. And also confirmed by what we can see in global ports. And obviously that leads us to this fun with the Fed cycle. And do remember that even before we started hiking rates, going back a year almost, we knew that the hiking cycle would end with a dramatic shift to cuts. That nature of the curve, when we were peak hawkishness in the fixed income market back in March, you had a long plateau, and that has been sort of withering away now with a shorter and steeper bump and coming off again. And we think that this bump is actually more correct than the plateau. And the thing is, you know, the number of reasons. One, the labor market, if you look at the variables that Yellen and Powell have been highlighting, i.e. Afro-American unemployment rate, low wage earnings, and no college education earnings, you can see that we're about to make the same mistake that made the Fed change their mandate or argue for different tilt in the mandate. As we're speaking. Now you can say that's justified by the CPA print, and I will certainly buy into that, but it's interesting to see where these things are peaking out. And do remember that before we even start hiking rates, we saw a cut, and if you look 12 months ahead and 1 year forward from that, you can actually see that we are now estimating that you're going to have 4.75 number of cuts per 25 basis points. So this is a massive cutting cycle that we are ahead of us that we're going to start to work through in 2023, even before we sort of reach the peak level. Obviously the second derivative of Fed Fund futures has been plateauing, which is sort of the pivot in our view, because that's what triggered the equity market. But this thing that we're going to hike and then it's going to start cutting again quite rapidly is obviously very different from previous hiking cycles, and quite interesting. Now this has obviously been front run in the fixed income market. If you look at 2 year forward on the 1 year and 5 year forward on the 3 years, so you capture that 3 year time span, which for whatever reason is very key for US rate market. It's quite interesting kind of behavior there. Also in terms of the Fed pivot speaking, you can see that peak hawkishness, and this is pushed forward, has turned into being more dovish, and obviously we think that's going to be leading the equity market in 2023. We believe it's going to lead the fixed income market in 2023, i.e. rates lower, equities higher. And I can't imagine anything more positive to have in your back than the Fed and their language. And how they view the economy in terms of being dovish or hawkish. Now, if you look at more on a nerdy level, this key or the pivot, i.e. when we went from 75 basis points to 50 basis points hike in December, that was back in October. Yes, we still believe that was the key moment, and especially for the equity market. This means that if you look at the underlying inflation gauge from the New York Fed, that actually peaked a year ago. And do remember that when we went into the hiking cycle, we knew we were going to end up with a cutting cycle. And I think this is the reason why. That we can actually see that the hollowness of the CPI pressure already back a year ago. And not to call it transitory, because obviously the travel here has been too rapid. But I think it's very interesting to see it from a point of view of the 10-year yield. If you look at our models, we see lower and lower 10-year yields. So we're long and it's actually making a very good contribution to our performance, even though it's a small position. So we have to be careful about this one, but still it's performing well. The whole idea of the pivot and why that was important is that if you look at the Fed fund rate versus the neutral level, as they have communicated, right or wrong, and you allow for negative term premium and you cyclically adjust this via Mercanto's nominal GDP calculations. And I choose to stop calculating or optimizing the model in 2020 just to see, could it forecast 2021? Yes. Could it forecast downside 2022? Yes. And now we're making quite an aggressive call for going to 2023. But I think this is the reason why the market is so afraid of missing out on the pivot. I mentioned peak hawkishness on a global basis, and that comes from the mere fact that lesser and lesser the net between hiking and cutting central banks is now tilting towards the cutting camp. Now that sounds, a bit more harsher than it actually is, because do remember that we've been in a long period where you see more and more hiking, and then all of a sudden, you have to peak at one stage, and now you can see people are reversing this. And I think this will be the name of the game in 2023 as well. We have already spoken on paradigms, we don't have to go through this, but if you look at equities, I think this year is quite noticeable that we only have had 117 trading days going back 12 months with positive equity outcomes. So that is historically a very low number, as you can see. You almost have to go back to the 30s and 40s to see a similarly poor environment if this was to be prolonged. We think it's going to be more of a V-shaped recovery into next year. And obviously this is greatly supported by the buying between institutions and consumers, net margin debt. You also have a positive sentiment outlook. You can front run the sentiment by looking at Twitter sentiment, positive as well. You can look at our global risk indicator built on rate spreads, CDS's FX vol fixed income vol, and you can see the most positive momentum we've had since for 2022. And then you can look at fear and greed, and you still have positive readings, which have been quite rare this year. And you can look at highs, lows, advanced declines, bullish, bearish, and you can come up again with the top side. You can look at, sell side pressure, non-existing, great historical pattern for Q4, even though, we really front run this from the beginning due to the fact of the pivot in the market. And then you can look at counterparty risk, dollar liquidity, vol curves, and you can also see a sharp upside for the equity market, and this tends to front run the equity market by some days. And also, quite importantly, last week flows came down to 1 standard deviation above. Now we're back to almost 2 standard deviation above, so we're getting flows on the top side as well. And we have positive gamma. And if you look at these type of more nerdy macro theorems, or equity theorems, I should really call them, you can look at, for example, Tobin's Q that has a 70% hit ratio, 67% hit ratio since 1950s. This is only the 5th time you have an equity sell-off without a collapsing Tobin's Q. That means if you look at the other 4 periods, 2018 to 1962, 1984, 1977, you're actually lagging, so you have some rebounding to do here unless Tobin's Q was to collapse, which it will not, because this just takes too long to shift into a negative state. And you can look at total factor productivity compared to normal productivity as a profit margin proxy, and you can see the sell-off has not been motivated as well. You can actually see a buying pressure, and you can look at the PE number adjusted for the rate cycle, and you can see that you moved into a hiking or buying mood as well. And you can look at whole Ubel, and you can see for the first time in 2022, the buying interest is the highest. People really do not want to miss out on this buying environment in the equity market compared to how desperate they are to capture the sell side momentum. So there's a number of factors speaking for the equity markets why we are quite relaxed in our strategic allocation for the equity market. If we were to look at what would then happen if ISM collapses, well, please do remember this graph that I've been showing now for several months, that yes, the equity market and fixed income market has already priced the sub 40 level on ISM. So bring it on in that sense, because we would all know that we're going to probably end up in 95-ish, i.e. equity market falls, macro doesn't care, macro falls, the equity market doesn't care. And you have this infinity sign here, which is great to play around with. But it's just fun in that sense that you almost painted the market into a corner by having this tremendously bad 2022, that even if the market macros are turning bad, it's not enough probably for 2023 to be a bad equity year, especially as the Fed will start cutting rates in 2023 because inflation will be imploding going into the summer next year. So it's going to be a fascinating first 6 months, I think. On the back of this, global macro troughing, earnings revisions troughing. If you look at earnings revisions, price revisions, and economic surprises, you have a good upside for the remainder of 2022 and into 2023. If anything, we're more concerned about the dollar liquidity going into the days between Christmas and New Year's and what it means for dollar SEK exposure. We will have more thoughts on that later on, but that's probably more concerned on that end of the risk table than the actual equity side. EPS is, yeah, they're fine in terms of forecast, but I showed this graph to really home in on highlight that EPSs don't lead the equity market. The equity market leads EPSs, so I'm not so sure, what do we dare to read into this. If anything, if EPS forecasts were correct, we should have more upside on the equity market, which, I'm quite happy to buy into that, but I wouldn't trade on that one. It's more important for earnings revisions that the economic surprises have troughed and start to bounce, which they have, regardless on how you measure these things. You have a little bit of positive momentum, which is great. This is exactly what we need for earnings. But also remember that economic surprises are troughing because the real economy is troughing, or re-accelerating, I should say. Obviously, that's already visible in national accounting profits, which sometimes actually leads the S&P 500, for example. So it will be quite interesting to see what happens with that one. And why are they not too concerned about the recession? Well, because leading indicators are indicating a trough on a global scale. We have a 25% recession risk in the US, not above it. If you look at the Fed themselves, they're 26. So it's quite a low recession risk. And we can actually see that indicators are rebounding on OECD. And if you look at daily updated GDP numbers in the US, if you look at Atlanta Fed, which is the one that Bloomberg likes to publish most about, you actually have a 4.26 growth rate for fourth quarter. So it's really quite interesting to start to flip the table on these discussions, say, well, we all know that growth will slow, and probably and hopefully will, because then the Fed can start to relax a bit, i.e. soft landing. This is the nature of the soft landing. But also that we're already priced a European recession in the equity market, and the equity market tries to sort of rebound on the back of what's going to happen globally, how the ECB will handle this. And that's really more the game that we have to play now, rather than being super stressed about the fact that, yes, up until next summer, you could end up in a negative GDP growth environment in Europe. But if the equity market is supposed to do the historical work, they have to start to bounce right about now, which is what they are doing and what we are putting our money on. The weekly GDP model in the US, flat. If you look at GDP, we'll have this data for Sweden this week. Yes, quarterly growth will come down, but hopefully and importantly not break zero. If you look at the Aruba, Diebold, Scott, the business conference, you have no downside risk really. If you look at Samroll, not there either. If you look at the usual data pointing that leads or defines the US recession, you can't really see a slowdown either. And if you look at global trade in volumes, i.e. we're not being fooled here by the CPI effect, you can actually see the volume is actually quite growing in terms of industrial production and in Chinese shipments. If you look at global foreign trade, you have still a very supportive and positive number. And if you look at freight activity in Red Sea, which is a nifty little indicator for world trade, you can't see a downside here either. So it's quite important. And as a final slide, I want to remind everybody on the fact that global credit impulse indicator is actually growing now in positive territory. And the Centix, i.e. both the confidence and the flows, which is Centix capturing, will probably start to ride this on the upside. And I wouldn't be too surprised if Europe makes a comeback when we get this data, which is lagging a bit. So it's not too much fun in this data actually. Now that was all. I will send out invitations for the webinar coming up in mid-December. We will strictly discuss 2023. Will be more of a discussion type of things rather than deriving short-term positioning, etc. We're always updated and we're always around, so just drop us a note and I will see you back in 2 weeks. Thank you.